Hi everyone, welcome to the 119th episode of the Timing Research Show and our first one for 2017. Today is January 3rd. My name's David Kosmeter. I'm the creator of Timing Research, and today we will be discussing the 171st weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports. You can download this or any of the past reports there. I have Rob Hanna back to host today, so I'm going to go ahead and turn it over to him.
Thanks. It's great to be back again today. Happy New Year to everybody. We got an interesting panel back here again today with a few guys that I know and have talked to before, and someone that I am not familiar with, I don't think. I'm Rob Hanna, for those of you that don't know, and maybe we'll just start off by going through the group here and let everybody introduce themselves. I'll start with James Ramelli of AlphaShark.com. James, good to talk to you again. You want to just introduce yourself and tell us a little bit about you and AlphaShark?
Sure thing. So my name is James Ramelli. As Rob just let you guys know, I've been on the show a few times before in the past. I actually have lost track of the number of times that I've joined you guys here on Timing Research. I always really enjoy the discussions that we have. But here at AlphaShark Trading, what we do all day long is focus on equity options, but specifically unusual options activity and institutional equity options order flow. So during the day, I sit in front of my screen and I watch a scanner that we have programmed with a proprietary algorithm that goes throughout all of the equity options exchanges in the country and tries to find interesting or unusually large trades coming from hedge funds and institutions, big traders at big investment banks. I then take that information and glean off of it what I can about what their expectations are for the broader market or individual names, and then set up a portfolio of options positions based on that information. So the last couple of weeks have been relatively boring for me when institutions are not around, meaning the guys that work for institutions are in the Hamptons or on vacation. Anytime there's a day off in a week, these guys take that as an excuse to take a couple weeks off of work. So around the holidays, we don't see that much institutional order flow, but that just means that I've got a lot of dry powder and can't wait to get into the new year here, and hopefully institutions start coming back to the table here and putting on some positions that I can use to get some good information.
Yeah, I'm sure we'll get some action soon. December's always a light month. You got volume dries up and volatility dries up and ranges are small, and there's very little to do if you're looking to make intraday money, or if you're looking to do like you do with the looking at big moves and options players, I would think.
Yeah, absolutely. These guys just aren't around.
Yeah. Anyway, welcome back, James. It's good to get to talk to you again. Jim Kenney of OptionProfessor.com.
Sure. Nice to be back, Rob. And basically, what I do is I provide the content for the Option Professor DVDs and information on the education of all the different uses and risks of the strategies out there. A lot of people are fairly new to options, or they have limited experience, and so it's very helpful for them to get information on how all the different tactics can work. Not only the buying strategies and the rolling them up and down strategies, but also ratio strategies and two-sided strategies like strangles and straddles, and hedging tactics like put hedges and collars. So there's a lot to learn out there, as we all know, and many people can benefit quite a bit by having an educational DVD set to kind of give them kind of a disclosure on how these things work, and then they don't work.
All right, great. Again, welcome back to you, Jim. And the last person I have on here, I had it written down as Anka, but I see on my screen.
Hi.
Hi, is that you?
That's me.
Okay, it says Christina on my screen in front
I know.
of me. I was confused.
I know. Over this weekend, I played around a little bit with Google and created a new account, to have our shared documents in there, because I didn't want to interfere with the original Trade Out Loud channel. So, okay, Christina's my first name.
Okay. All right. Well, it's great to have you here from Trade Out Loud. Can you tell us a little about your trading and about your website?
All right. I'm a professional independent trader that is focused on equities and futures, day trading and swing trading. I've been doing this for the last 14 years. I also run a managed accounts program for over 10 years. And before becoming a professional independent trader, I have over 10 years in investment banking. I'm also the founder and CEO of TradeOutLoud.com. And I'm the designer of an institutional proprietary trading system that is based on price support resistance, specific trigger times, specific price zones, chart synchronicity, a strict set of trading rules, and a 10-point scoring system that enables any trader to identify trades with ease. Our trading firm is specialized in educating individuals how to day trade and swing trade equities and futures. We also offer a signal service that a signal service for futures, for day trading and swing trading futures that we will launch next Monday on January 9th. We're actually running free trades right now on my Twitter handle, which is Anka Metcalf. And also we're offering a lot of education. We're offering swing trading education for equities, and we're offering day trading and swing trading education for futures as well. And we're also running alerts for swing trading equities.
Okay, great. Sounds like you got a lot going on over there.
Mm-hmm.
You mentioned futures trading. Is that index futures or commodities or both?
Index futures and commodities. Okay. Index futures and commodities. We actually have a trade going on right now in silver. So
okay.
Watching the charts.
I'll let you keep one eye on that, but the other eye's got to be over here. Yeah, I think we all glance over at our screens here while we're talking too. That's what happens when you get a bunch of traders talking. But David always times the show nicely, so it's during these slow lunch hours, right? So people can listen and we can talk without too much distraction going on. Again, for people that don't know, I'm Rob Hanna. I work with a few websites. One is Investaquant.com. That was originally a couple of websites. One was Master the Gap, which was started by Scott Andrews. And then I started a site called Overnight Edges, and they merged a couple of years ago and became Investaquant. And we focus on quantitative trading, and we publish odds based on historical data, and we have systems and other tools for traders there. Additionally, I have a site called quantifiableedges.com that's been around since 2008, and that's got a newsletter attached to it, and it focuses on swing trading in indices and large cap stocks. So let's get to it. This is our New Year's edition. So we've got a lot of prediction type stuff. Both we're going to be looking at predictions for this week, obviously, like we do every week. But we're also going to be looking at full year predictions, which will be interesting. So let's start. I'm going to go from top down on my sheet here. So we'll start with you, Anka. Could you give us an idea of what direction you think the S&P is going to move this week, and then give us what your confidence is based on that. So you think it's going up or down, and how confident from 1 to 100 are you in your guess?
Okay, I know you guys, and David especially, wants a clear up or down, higher or lower. However, if I can share my my screen really quickly. Okay.
I think you can, but I can't instruct you how.
David taught me how to do it. All right. I think you guys can see the screen right now.
Yep.
All right. So here's what I'm looking at right now. So we did get a trigger this morning, and we ran higher. So that means that it puts the S&P 500 into a void all the way into this prior high at 2277. So this is what I'm looking at right now. However, I think the line in the sand and the decision point is going to be at 2238 area, where we have a hefty area of support here from this flush down on Friday, last year that we had. And I think that if we're going to break, so for me right now, it's like a 50-50 shot of higher or lower, because to me, if we break the 2234 area, we're going to go back all the way to 2214 area. And if we manage to stay above this area, this 2236 area as support, we can actually continue to go higher into the 2277 area. So my crystal ball is a little foggy right now, but from what I'm seeing right now, as long as the support area holds the 2236 area, we're going to head higher.
So it sounds to me like 50-50 chance of a move up, but in your view, potential upside reward is larger than downside risk because you've got the support close and the resistance far away. Is that? Yeah,
it's like so far at this support level, it's kind of like a one-to-one risk to reward level right here. So it's very aggressive. There was some buying off this morning, and especially in the overnight session and the future indices that pushed the price higher and actually created the gap up. But to me right now, it's very unclear. In order to continue higher for at least for a short to medium term, we need to break this high right here of 2277. That's when we're going to get more clarity as to where we're going to run into. But I think that's going to be the second question that probably we're going to run to as expectations for the year and so on and so forth.
Okay. All right. So you're
okay, so
50-50, but leaning more bullish, it sounds like.
I'm going to go with higher. Go with higher as long as the support level holds here at 2238. If the support breaks, then I'm going to be lower. But okay, I'm going to say 60% higher.
Sounds good. All right, James, tell her why she's wrong.
No. James is on my side.
So I have to say that I agree with a lot of what Anka said. It's really difficult to get a good read right now because we take a look at price action over the last 3 weeks. I would say very little of it actually matters. I mean, does it really matter where we're drawing in support and resistance in these super thinly traded markets over the holidays? Not really. I mean, if you take a look at the last 10 days, we had the tightest range of the whole year within that days, and there was 3 days where we were pretty darn close to being able to say that, right? I mean, really not a whole lot of price action that was super telling, but at the same time, I still think that if we take a look at the chart here, and I've got my screen up now, of the S&P futures on the daily bar, the E-mini S&Ps, what you do see is that a lot of these candles have these big wicks on the top of them, and even though we're still pretty firmly inside of this range that we've been consolidating in for basically all of December, it looks to me like any little rally has been sold, or sellers step in on any little rally. And if you take a look at the way that we're trading today, a fantastic example of how that dynamic has been playing out. We're still inside of Friday's range, not that really matters all that much. But if you take a look at what we have here, we're below the point of control for the month. We tested up to it right here, and this level right here was 22.59 half. I mean, we got there, I think, to the tick today and then backed off. That tells me that at least as of right now, coming in here on Tuesday in what is probably going to be another thinly traded week, that traders are selling rallies here. Price action through today at least tells me that it's going to be kind of hard for the market to catch and sustain any kind of bid this week. So I actually think that the market is going to be heading lower from here. I think that if we came in and we were down a lot today, it would have been harder for me to make that same type of call. But I mean, it looks to me a lot like the pattern that we've seen play out over the last couple of weeks here. And if we take a look at what we're implying through the end of the week with the market around 22.42 here, they're really only looking for about another 19 handles worth of action up or down by the end of the week. That's at least what the options market is telling us. So with that said, I think we kind of continue to sort of chop sideways and grind lower into the end of the week. And coming into next week, then we actually have some catalysts that are going to be coming out. I think Alcoa earnings are on the 10th or the 11th, and that's when we'll actually get back into a environment where the market has something to trade on other than Donald Trump's tweets and individual equities and kind of thinly traded price. No, seriously, I mean, what catalysts have we had over the last couple of weeks outside of, kind of micro catalysts in individual names, headlines, or, the occasional let's all get short tweet from Trump. So once we get out of that dynamic of the, I think traders start to step back in once we get back into earnings here, and then we'll find some, trend in the more medium to long term here. But as of right now, I'm a seller of any rally. I'm really only looking for unusual option activity that points towards sort of medium term shorts through the end of this month, beginning of next month.
Okay. All right. Interesting. And so you're saying lower. Do you want to give a number to that confidence number?
I would say about 65 to 70% level of confidence. I given the reversal today, even though it happened on light volume, but I can say that about any move that's happened over the last 10 days or so. Even though it's happened on light volume, I think that's indicative of how price action is going to play out through the rest of the week. And with no real big catalysts between now and next week, I know we got the jobs number coming up, but that hasn't really proven to be too much of a mover. Even looking at the straddle, it's not saying that we're expecting a huge blowout move one way or the other. I think that's what we're going to see into the end of the week. About a 70% level of confidence.
Okay. All right. Thanks, James. All right. So, Jim, we got one higher, one lower.
And I'm going to kind of go a little bit closer to where Anka was in that the trends are up, but they are overbought. And the VIX went up towards around 15 and has rolled over a little bit. So if we can hold the 2230 and the VIX continues to go down, then the more likelihood would be for a rise here. So basically, we're overbought to the tune on the 200-day moving average on the Russell. We're up at 1354. The average is at 1208. The S&P's 200 days at 2136. We're up where we are. And the NASDAQ's 200-day is 5093, and we are where we are. And the transports and the Russell, have had more significant pullbacks because they had more significant advances. But the transports have taken off about 500 points off the high. Their moving average is way down at 8,069. So they're almost 1,000 points above their averages. So the problem with advancing from here is that you're in an overbought condition. And it's very difficult to dismiss that without any great news. I was listening to Abby Joseph Cohen over the weekend on Bloomberg, and she made a good point in that a lot of crystal balls are a little foggy right now because we don't know what the policies are going to be when they're written. Like James was just talking about, we're going to go beyond tweets, and we're going to get policies on repatriation of all those earnings offshore, and we're going to get policies on, whatever he's going to have policies on. And we're going to go from the tweet world to the real world, and it's going to be a little bit uncertain on how that's going to play out. But, that's basically what I'm saying. So, we should be possibly rising as long as we don't take out that 2230. But because we're so overbought, a correction through those numbers is certainly not off the chart.
Okay. All right. And I think we're starting to lead into that discussion of what's going to happen after this week. So we'll get to that soon. But I think it'll be an interesting year. And so I'll give you my take on the week as well. We got two higher, one lower. James, I'm going to gang up on you here. And I'm going to have to say higher also. The reasons that I'm seeing for it are that we had a strong, well, not strong, but we had a sell-off going into the end of the month. And typically, when you get sell-offs going into the end of a month, that does set things up for a decent bounce. The next, or to start off the next month, I did one study over the weekend, looked at when the S&P's above its 200-day moving average and it closes in the lower half of its daily range going into the last day of the month, and it's also down at least 2 days in a row, what happens if you buy that and sell, 1, 2, 3, 4, 5 days later? And it's happened 25 times in the last, 23 years, 24 years. And 19 of those times, it's been higher 3 days later. 18 of those times been higher 4 and 5 days later. And the average rise has been about 1%. So those tell me we got some pretty good odds of moving up here because we're very short term. oversold, meaning just over the last few days, and we did close at a 10-day low on Friday as well. So that is a bit of a oversold measure on a real short-term basis. The other thing is that we do still have some positive seasonality, year-end seasonality, the Santa rally type stuff. Typically, you get a continuation through the first couple of days of the new year. Doesn't always work out, but many of the studies I've done have shown like through day 2 or so of the new year, or into day 2 of the new year, you're better off holding those Santa type positions. So for those reasons, I'm looking for a little bit of bounce here. I think we'll probably move up over the next few days. I don't know that my confidence is as high as the 75% that I saw in that one particular study, but I'd say I've got 65% confidence in it, and I was seeing some solid 5-day odds shown by the InvestiQuant swing edges data as well. So that was showing chances of SPY being up over the next few days as like 60%. So that's pretty strong for those numbers. So I'm leaning long, and those are the reasons why. And like I seem to do almost every time I host a show, I do a terrible job of separating questions 1, 2, and 3, because we have basically gone through and answered not only what direction we think it's going and our confidence in it, but also everyone's described why. So there's not a whole lot of surprises there. But what I would like to do is go through quickly and ask if there's anything else that you guys are looking at in this upcoming week, news-wise, technical-wise, fundamentally, that you may not have factored into your original answer. And then we can move on and get into some fun year-end or 2017 predictions. So let's start from the top again. Anka, is there particular events occurring this week that you're focused on outside of the upper and lower bands you were talking about there?
Not particularly for this week. Like I said, I think we're going to have a slow start to the year, and I think the volume is still going to try to pick up, let's say, into midweek, and I think we're going to be in full gear next week. And in terms of economic events, I'm more interested in starting the earnings season. I think that's going to be a good catalyst behind some of the moves. And like James mentioned earlier, we're going to start with Alcoa early next week. So that's going to be the first move that might occur in the market, and I think that investors might be, focusing more on these earnings than other economic releases. Other than that, I don't see a lot of economic releases. Actually, I do have the calendar right in front of me, so there are very few ones. Even because I trade the futures market as well. I'm looking at European markets. I'm looking at Asian markets, and I don't see anything that pops up, right away. But to answer one question, because we've been talking about confidence, and I think, what is our confidence level? And I think that because we're all here technical traders, our confidence comes from the technical pattern and what we see in the technical pattern. And James actually, I liked what he said, that this pattern is setting up on low volume. So that is so true, and I think that what's going to come in after today is what's really going to set the tone for the rest of the week.
Yeah, that is a good point, and it's that you both made there. With the it's tough to read a whole lot into low volume. It's dangerous to do that as well. So, James, is there anything else you'd like to add about this upcoming week or early next week? I know you guys both mentioned Alcoa. They always do lead off the earnings, and I would hate to deal with any of the people in their accounting department who I'm sure are screaming at everybody to get their expense reports in on time, because they have to do that every quarter.
Yeah, so they're going to be reporting earnings next week. You know, a lot of traders look at Alcoa, and you know, I understand the logic behind it. They look at Alcoa earnings and kind of think of it as a bellwether for how the rest of the cycle is going to go for other names, and I understand that logic. You know, they're involved in a space that, you know, one could argue their success should, you know, lead to, or at least point to, the fact that the economy is relatively strong. But if you take a look at historical data, there's actually really no reason to justify that type of thinking when you're talking about Alcoa earnings. The stock reports, it gaps one way or the other, really doesn't lead to a statistically significant kind of read on what's going to happen to the broader market for the rest of the quarter. So it's a little bit more about kind of getting into the swing of the earnings cycle. In that first part of the cycle, the first 2 weeks, we usually hear from the banks as well. And I actually think that that's going to be way more important this cycle, at least in the early part here. We're going to be pretty focused on that because, you know, financials have had such a huge tear to the upside and have really kind of led the rally in a lot of the broader market. And if they come in and their expectations are a little bit softer, or, you know, they're not necessarily pricing in their forward guidance all of this euphoria that the market has priced into the stocks at this point, I think we could see a situation where it's going to be kind of hard for the market to rally if these things come in flat, or not necessarily with these perfect numbers and guidance that the market is kind of expecting at this point. Then we'll see some action. I think then in the broader market, it'll be really difficult to rally. So until we get to that point, I really don't think there's a whole lot in terms of catalysts. Like I said, the jobs number is this Friday, but I don't really care about the jobs number this
you got
week.
A job, right?
Yeah, I mean, I've got a job. You know, it's not a problem. But, you know, at the same time, you take a look at the way the market has traded on that number over the past couple of months. Nothing really ever happens, and volatility is not indicating that we're going to see any kind of big surprise, or that it's even something that traders really care about that much this week. I think we would see the VIX much higher. We'd see the at-the-money straddles in our indices priced much higher as well, and we're not seeing that. So my call was based entirely on price action and kind of the patterns that we've been seeing in the market during these thinner kind of light holiday weeks, coupled with the fact that I really don't see any catalysts this week that might snap us out of that pattern, or necessarily you know, cause the market to move with any kind of serious momentum or velocity.
Other than some surprise tweets, right?
Yeah, that's the thing. If you want to take a look at the individual names, just keep an eye on Twitter. I mean, we had one in, I think he tweeted about GM.
Right. Yeah, this morning.
Yeah, this morning, and I didn't really take too close of a look at what happened to the stock, but unless I have a black box that's able to kind of parse out the comments on Twitter and stuff, not really something I can use with any type of action. But again, like I said, lack of catalysts for the broader market, maybe a few micro catalysts here or there, not going to be enough to you know, cause a significant move in the underlying market. And I think that once we get into the earnings cycle, particularly financials, over the next 2 or 3 weeks, then we'll start to see some action there. Because like I said, if they come in weak, then the market probably reverses and breaks out of the range of the downside. If they come in and say, yeah, you know, you guys are all completely correct, we're expecting this to be the greatest 4 years in the history of banking in the United States, then the market probably takes a leg higher, right?
Right. Okay. All right. Yeah. Interesting. All right. Let's move on to Jim.
Sure.
The last one here. Is anything in particular you're looking at this week, or
well, most of the stuff, most of the stuff that's coming out is supposed to come out pretty much as expected. The ISM manufacturing and the PMI above 50, you know, everything's good there, and the unemployment's supposed to be 4.6. That's pretty much in line, and then the trade deficit is pretty flat. So the only thing that might be a little bit of a mover might be the dip that they're expecting in hourly earnings. Because when everybody is as high as a kite, if anybody mentions coffee, you know, it might change the mood a little bit. But the one thing that you guys were talking about on low volume, you know, we had a very large rally, as we all know, after the election, which you have to question how much of that was short covering and people basically getting wiped out on their hedges that they put on. in case Trump got elected. And then, of course, we have the window dressing buying for people who are managing money and have to show that they're long the market. So we have those guys all pretty much done. And now we're looking for new buyers up here. And we're looking for new buyers with the moving averages way down where they are. And that's what creates vulnerability up here. And with the VIX 2 weeks ago hitting under 11 for the first time since 2015, when the last time the VIX did go underneath 11, we saw a volatility spike in August of 2015. I'm not saying that's going to happen again, but it may not be coincidental if we see a spike in volatility. So, as far as the volume is concerned, we got to find out who wants to buy this thing at the all-time high without any written policy details, without any Q4 earnings details, and without any, trying to figure out, what's going to be happening with this guy.
Right. Okay. Well, I don't have a whole lot to add as far as anything for this upcoming week. So let's get into the perhaps more fun discussion of 2017 and where we see things there, and what are some things that we'll want to look at. Let me mix up the order here a little bit. I'll start with James Ramelli, and let you give me your prediction for. Let me see how the question was worded. I'm sorry. I don't want to mess it up on David. So in 2016, we opened at 2038.20 and closed at 2238.83. Where do you think the S&P will close in 2017? And just so you have an idea, the average of the respondents was 2,318, up about 80 points, almost 4%.
Yeah, I mean, I think I'm actually surprised to see that's the average of the responses from people that took part in the survey. I mean, if you would take a look at the way we've traded over the last, since the election, you would think that everyone is expecting the SPOOs to go to 5,000. I mean, that's a pretty kind of tempered estimate, I think, from a lot of people, and I think that's relatively reasonable. I mean, I'm pretty bearish the stock market in kind of the longer term, but 1 year from today until the end of 2017 isn't really a long-term type of view, right? It would be for some people. For day traders, it might seem like an eternity, but I think that's reasonable. I think that if we do get the policy changes that we're expecting, and I really like what you said about that. I mean, there's not a single bit of written policy yet. He's not even inaugurated, and we're already pricing in these like massive changes to the tax code, to regulate. I mean, financials are higher on the assumption that we're going to have a completely gutted and different regulatory environment as well. And I mean, there's a lot of sectors that have traded based on those types of speculations so far. If all that happens, I think the market will move higher. This past 2016 was kind of a strange year because we had such a stiff sell-off at the beginning of the year that, all of the rallies we had after that were really trying to play catch-up or, in recovery mode after that big sell-off. So, if I were to, I really don't like to come up with like long-term price targets because I wait to see what the market has to tell me via unusual options activity, and in names like they're in indices like the SPX, the Dow, and such, it's almost impossible to glean what it is institutions are thinking from their order flow. There's just too many things that they could be doing. They could be hedging books of equities. They could be hedging their exposure to the indices. They could be doing big, humongous vol plays. You never really know. So I think that's a decent target to the upside. I would say that the market will finish the year higher, not by a huge amount. And it really kind of, I think at this point, depends on what we get in terms of those policy shifts that everyone's expecting. I think to assume that every single one of them is going to go through is probably I don't want to say a dangerous assumption, but a bad thing to assume. I don't think it's going to be nearly as easy as everyone kind of thinks it is for him to push forward his agenda. But with that being said, I kind of look at the market over the course of a year on a quarter-by-quarter basis, and kind of let the earnings at the beginning of the quarter color my expectations for the rest of the quarter. And then, of course, the unusual options activity that we see after those initial earnings releases show me how big institutional money is kind of positioning themselves. And unfortunately, with the month that we just had, there really isn't a whole lot that I can say about what they're expecting through this first quarter, because the order flow just hasn't been there.
Okay. Yeah, it's up slightly, I guess, is what you were.
Up slightly, and I know you guys want a specific.
I want to summarize it, but
a specific target there, but I don't think that I'm gonna give one. That's just not something that I am in the business of trying to do. Typically when
you're not talking to any long-term investors here, right? I mean,
yeah. typically what I like to do is and I'll share my screen here really quickly. Typically what I like to do when I'm trying to develop targets is, I'm not a huge technicals guy. I never really have been. I like to use the options market as my lead for what we might see over a certain period of time. And as I was talking earlier about the straddle expectations for this week, I can take that same idea and figure it out for any of the expirations that I have listed here in front of me. The only problem is once we get past, I would say like 6 weeks or so, the amount of time premium that is built into the options kind of skews what the market maker's actual expectations for movement might be. So, looking out like 1 quarter for expectations might give me a somewhat of an idea of what the actual expectation for the market is, but isn't going to give me like a super clean read like it would if I was looking between, now and Friday, or now and the end of the month even. But, what we can take a look at, and I think that this is a pretty good representation of people's expectations. We're not expecting like a ton of movement through the first part of the year here. I mean, they're pricing in 41 handles worth of movement through January expiry in S&P, E-mini S&P options. That's not a huge amount of movement over the course of the next 17 days, especially when we have a jobs number, when we have a new president that's being inaugurated. So, that's kind of where I guess draw trouble with actually picking an upside price target. I think we're going to be in a pretty slow grinding environment unless we get some earnings surprises.
Okay. Yeah, makes a lot of sense. And like I said, you can't predict the future. I can't remember it exactly, but basically, the farther out you're looking, the less accurate your predictions become. I can tell you what the weather is now, and I can tell you what it's likely to be in an hour or two, but what the weather is going to be like in this same time next year is going to be a little more difficult. At the same time, we do have some things we can look at for the market, and Jim is going to tell us exactly where it's going to be a year from now.
Yeah, that's right. Well, we had a big melt up after this election, and I think we're kind of in an overbought condition here, whether it makes a new high by a little bit or a lot or whatever. History is, sometimes worthwhile, sometimes it has no value at all. One thing I was listening to as far as valuations with Abby Joseph Cohen on Bloomberg was that companies, when they had cash, used to spend 70% of it on growth in some way, shape, or form back around 2000. And currently, they're spending about 40%. So where's the other money going? It's going into buybacks and dividend increases. Now, I think that's going to be the key this year in that what are they going to, if they do write some kind of a repatriation of the profits bill, and if there's no parameters on it at all, and the money goes right back into buybacks and dividends, that's going to be very, very positive for stock, and the market may advance much further than anyone thought. The trade deals that he's talking about, what are they going to look like when he puts them on paper, and the value of the U.S. dollar? The higher the dollar goes, it's a rough racket for U.S. companies overseas. And then how high these yields are going to go. Right now we've had a big pop in yield. I think the Fed's behind the curve because the yields on treasuries have gone up a lot more than 1/4%. And so I think those three things are going to be really a big factor. The big line in the sand for me is this 2000, 2100 area on the S&P. As long as we're above those levels, it seems like being constructive on stocks makes more sense than being negative on them. But you've got to find people to buy this stock up here Maybe it's going to come from the repatriation money, and then that'll be the surprise on the upside. But there's a lot of wild cards this year, and so with the volatility so low and the prices having advanced, some people looking into strategies that I'll talk about a little later that either have hedging vibes to them or non-directional as far as just looking for volatility, may be the strategies to focus on in the next months ahead.
All right, great. Yeah, you bring up a lot of good points there. Dollar moves and the yields on bonds, as well as all the policies that we've been talking about that are going to change things. But yeah, this is the first time in a while that we have been seeing yields move higher, right? I mean, and we'll see how high they can go. But any move from effectively zero is a pretty big move, right? So it takes some adjustment. And you're right, the Fed hasn't increased their rates at the same rate that we've seen some other yields go up. So there's probably some more of that coming as well. So yeah, a lot of good points there, Jim. Anka, can we see what you actually wait, Jim? So bottom line was a little bit higher.
Yeah, I would say as long as we're above 2,100 or 2,000, it could be a situation where we had a melt up going into the aftermath of the election. We could have some shakeout to, obviously, or sideways or shakeout to kind of get these moving averages to catch up to the price a little bit. And then, of course, after a shakeout or a pullback, if these levels of 2,100 and 2,000 are obviously intact, maybe later in the year they could advance the market up towards a new high into the 2,400 area. Again, if they repatriate money, they don't put any parameters on it. These guys can buy back their own stock. They can keep the prices going. The earnings will look better because of the buyback of the stock, and that'll set the tone to get into that new high area. Okay. If that doesn't happen, then obviously, you got to be careful. So I would say, going up to 2,400 is clearly in the cards if they take the repatriation money and let them just do what they have been doing, obviously, which is buying back their own stock.
All right. So it sounds like we got so far 2 people that are looking for the market to go a little bit higher. Anka, you're going to join the party?
I'm with them.
All right.
We're going to push the market higher. Okay, so I couldn't agree more with Jim, and I'm going to share the screen just, okay, here we go. All right, and when Jim was talking, these are basically the levels, and that he was talking about the 2,100 level, which is this pullback right here that happened into that election, and this is where we had the Brexit. So this is the 2,000 level that was bought. So if there's anything that we have learned from what we see right here in this chart is that all these pullbacks were being bought, and all these pullbacks have been bought, whether shallow or steeper pullbacks, they have been bought. And this is because we are in a very, very strong uptrend and nobody's giving up. I mean, let's face it. I mean, where else are you going to invest? And I think the stock market and futures market is the best place to invest right now. And people are realizing that. And there are more and more money that are being thrown into the markets every single day. And you can just see the footprints that are all over this, all over the charts. In terms of your question, where do I see the SPX going into the end of the year? And it would be very interesting if David is going to get back, is going to bring us together next year at this time, and to try to get a feel of what we were talking a year ago. That would be very, very interesting. But if we're going to get a steeper pullback, and one that James actually was talking about, and I think the area is going to be, and I'm going to give a cushion area, is going to be 2215 in the SPX all the way to about 2190, 2180 area. So this is going to be the cushion area that I'm seeing the pullback into. And I think that even if we get a steeper pullback into this let's say 2200 area, just to round it up. I think this is going to be another area that is going to be bought. In terms of where I see the market going, obviously higher, and I'm confident that it's definitely going to go higher. I'm not into a hard sell or anything like that, just because the trend is very, very strong, and I think the market is going to have a very hard time having this major correction to the downside, because there are different layers of support that is going to create a lot of issues, and there is still going to be a lot of traders that are going to go long on these dips in the market. In terms of where I see the market going, I see it probably reach 2400 for the end of 2017. So like I said, I don't have a crystal ball, and I think we have to take it each quarter at a time, because it's going to be in strict correlation with the economic events that are going to be throughout the year, and also we got to evaluate the earnings that are going to come out every quarter. So I think there are a lot of things that we're going to see ups and downs and corrections, but the overall trend, I think it's still higher, and I think we still have room to move higher all the way to a 2400 area.
Okay. All right. Yeah, that would be fun if David brought us back next year to rehash our predictions and to mock whoever is wrong and gloat on those who are right.
That'll be fun.
So I'm gonna take the other side
notes
of it here.
for the end of the year.
What's that?
I'll put that in my notes to try to set that up for the end of the year or early next year.
Okay. All right. Yeah, that'd be fun. Like you guys, I'm not a long-term trader, and I don't put any trade ideas out there that would suggest someone hold for a full year. So much of what I'm going to say is more speculation than it is something that I'm actually going to trade on. But I do think that we are probably due for a down year here. There's a few different reasons for that. From a seasonality standpoint, years that end in 7 have been the second worst of all of the numbers. Years that end in 0 have been the worst, but 7 has been second worst since 1900. Years that end in 7 have averaged a was it a 4.7% decline or something? That's a quarter, 4.1% decline. That's according to Jay Capel in his seasonal stock market trends book. And I'm not sure how much I get into the decade thing. There probably is some value to it, but sample sizes are pretty small. Going back to 1900, you still only have 11 instances. So we've got a pretty small sample size there. Jay has found that there has generally been a dip in year ending 7 or 8. And so maybe I'll put a little bit of stock into that. The other point, though, that I do believe a bit more in is the presidential cycle. And we're now in the first year of a presidential cycle, and the first year has generally been the worst year, and it has been even worse when you've had a new president as opposed to a second termer. And that part of that, I believe, is just the fact that there is going to be change. New presidents come into power, and they want to get their policies enacted. And one way, probably the most popular way to get new policies enacted, is to tell everybody how terrible things currently are. And Trump seems to do a pretty good job of that, saying this is a disaster, or that's the worst deal ever, or whatever it is. So that does create some negativity in itself, and that could be a potential reason why the first year of a presidential cycle generally suffers while they're talking down the current environment to try and get their new policies in. The other thing is, when we put in new policies, certainly they are change, and any change is somewhat feared by the market, and you're also going to get the other side of it. You know, I'm sure any new policies that Trump puts in, you're going to have Democrats telling you on television how terrible those new policies are, and why they're voting against them. So it's it tends to be a bit more volatile. There's more uncertainty, and those kinds of things can lead to sell-offs. Anka mentioned that all of the sell-offs we've seen in the last few years have been bought. You know, the Brexit was a quick sell-off. China last year in 2015 in August. I mean, that lasted for like 4 days, right? So every time we've had a sell-off, basically since 2011, it's been bought very quickly, and it's led to new highs very quickly. So I think we're kind of overdue for, well, what if we don't get that sharp bounce? What if the initial dip buyers find out they're not immediately right, and that could lead to some extra pain. So I think we are due for some potential pain in 2017. I don't know that it's going to start right away. Summer of first presidential years tend to be the worst. You know, the old sell in May and go away. So maybe we've got a few more months of good times, and then it happens. But I would predict closer to 2000 than going the other way for this year. And like I said, it's not something I'm putting money on right now, but it's in the back of my mind with my trading that we may have some more volatile conditions to deal with. So that said, I guess we're getting a little short on time here. I want to give everybody a chance to give a trade idea, and it can be a long-term trade idea if you want, or it can be a short-term one. I think probably most of you will be suggesting short-term ones. And also let us know anything that's going on with your website, with your work, and where we might be able to learn more about you if people are interested. So let me mix it up again. Let's start with Jim. He hasn't gotten to start at all. So Jim Kenney, you got any trade ideas?
I always wanted to be a starter. I was tired of being a sub, you know.
I had you at the end of the bench the whole talk too. So.
I was gonna say, and I can shoot, you know. Anyway, well, you know, I'm not giving out specific ideas ever, but I do talk about strategies. And again, people can consider the strategies and then plug them into whatever they think they're doing, see if they make sense, make their own decision, figure out what it makes sense. As I look into this year, you know, there's three. I watch all 5 areas pretty much: stocks, interest rates in the dollar, metals, oil, and agriculture. And so 2 things, you know, sometimes they have different, obviously, volatilities going on and different values. On the stock market, if there is vulnerability this year because of the new president, because we got overbought, because maybe they can't repatriate and buy their own stock as much, and we can't find a whole bunch of buyers up here at 2,300, and vulnerability does come in, it might not be a bad idea to understand how put hedges and collars work. Which are both used as a defensive mechanism sometimes in conjunction with a position that you're holding. So those would be 2 strategies right off the bat that would be interesting for people to be aware of. And then the last one would be the volatility in agriculture, like soybeans right now, or volatility in metals like gold right now, and volatility even in the S&P. You know, are at relatively low levels, and sometimes that is a precursor to volatility picking up. So a strategy such as a strangle, where you're doing calls and puts on the same situation, if the premiums are reasonable in your opinion, and if volatility does emerge, sometimes they're an effective strategy, because then rather than trying to say, is it going to go way up or is it going to go way down, you say, who gives a poop, I got something cooking on both sides, and if it goes dead in the water, I'll lose on both sides. But if there is big volatility, something should click. That would be something to consider in some of these markets where your volatility measurements are quite low. So that would be my input going into this year is learn as many strategies as you can that might be conducive to the environment you're looking at, and just try to do the ones you understand, the ones you can figure might be good for you.
All right, great. Thanks, Jim. Always interesting getting to talk to you. You always got a lot of good ideas and input there as well. So thank you for coming on and talking with us again. Anka, I'll go back to you. James, you can be the anchor man.
Okay. All right. I'm going to share my screen again. Okay. I actually have posted 3 trades this morning. First one is FCX, which is the long right here into this area. It's a pullback into a support area, into a minor support area. Your protective stop is $13, and your trigger for this trade is $13.70. The next projected targets for these trades, for this particular trade, is going to be $14.50, $15, $16, and $16.25. This is one of them. And I'm going to share one more with you since I'm very quick with this. Precise entries, precise targets, and we're done. So MU, after the gap up, I thought it was going to be actually a gap and run here. So I did try it higher. I got a better intraday entry on this one, so it was not at this high right here. However, I had a stop at 22 at under 22.70, so it obviously was not a gap and go situation, and the stock pulled back. And so if you were in this trade, obviously, and I was in this trade, you would have stopped out, or if you would have waited for a pullback, if you're not fully position sized, you could have waited for the pullback and never sell on red. That's an amateur thing. Never sell on red. If you're captured in a trade, wait for the trade to pivot before you actually place in a hard stop. So don't be a novice. Other than that, the trade triggered today, and this is an alternate entry at $22.40 with a protective stop. Under $22.60, and targets into $23 and $23.60, and obviously it has some long-term targets for MU all the way into $25, and we're going to see how that's going to play out. So for more trading ideas, you can also visit Twitter, where I'll continue to post free swing trade ideas and day trade ideas for equities and futures on my Twitter handle, which is twitter.com/Anka Metcalf.
Excellent. Thank you. It was a pleasure getting to talk to you, Anka. I look forward to talking to you again sometime.
Awesome. Likewise.
All right, James. On to you. You got any equity options, unusual activity there that are sparking some trade ideas for us?
Yeah, so I actually don't really have much in my book right now past some of the first weeklies in Feb. So I've got a relatively short dated portfolio right now, but kind of, I think, one of the bigger themes throughout it. I don't have a ton of positions on because, like I said, the market hasn't really given me a whole lot over the past 3.5, 4 weeks or so. But I have a couple of shorts on in a couple of retail names. One of them is Coach, and the other is DKS. If you take a look at these charts, and I'll grab the screen back here, you would really have no idea by looking at these charts that consumer confidence and consumer sentiment is like the most bullish it's ever been, and that the stock market is just off of all-time highs, because these charts are really weak. They have earnings coming up, both of these names, through the end of the month, and I think I am looking at probably some of the more significant activity that we've seen over the last couple of weeks has been on puts in these names. I don't have anything on in like the XRT or anything to play the sector. Typically, I like to focus on individual names that I see flow in, and Coach and DKS are some names that I've seen that bearish order flow. So far, I'm long the 33 strike puts in Coach for January and the 50s in DKS for January. Both of those are probably not going to work out here, so I'm going to be looking to roll those forward sometime soon here. So at the very least, I can capture the next earnings event, which hopefully would bring some volatility in and help juice up my position while at the same time giving me the directional move to the downside that I need. This is something that I'm kind of waiting for institutional money to do as well. Typically, when you see big order flow in equity options, if the institution is wrong, you'll either just see them go out at zero or they'll come in and roll the position out. And because it's a big line of options, it's pretty easy to just kind of keep an eye on it and see, all right, well, here they are taking out all of the open interest in this particular line today, rolling it out to a less aggressive strike on a longer dated expiry. So that's kind of what I'm keeping an eye on now. But if I want to have a balanced book, I think it's good to have some shorts on, even if I am sort of moderately bullish the market through the first quarter. And I think that this is a good way to approach it. I liked a lot of what you guys said there in that last question about how, just how there's so much uncertainty around where we stand right now. I mean, we all have these calls, but if yields get too high, I mean, that could change everything that we've talked about here. I mean, we're at I think we crossed 2.5 today for a little while, and north of like 2.75 and 2.8 is where all the investment banks had issued their warnings right after the election that the yield growth trade-off starts to look a little less favorable for equities. And there's a lot of other questions too. After this first quarter, if earnings come in weak and the market sells off, if Trump allows these companies, multinationals, to repatriate some cash and buy stock back in the next quarter, well, then it probably doesn't really matter what their earnings are going to be. They can report whatever they want, announce a buyback, and we'll probably see the stocks rally. But at the same time, is that going to be enough to offset what some of these multinationals have seen happen in their treasury departments? I mean, we've had like massive repricing of exchange rates since the election, and that might be an issue for them as well. So a lot of uncertainty, a lot of unknowns, which is why I'm kind of sticking with order flow here in the short to medium term and trying to stay as balanced as I can between shorts on weak charts and longs on stronger charts.
Yep, makes sense. All right, thank you. As always, good getting to talk to you as well. I'll just give a quick trade idea here and then wrap things up. Or David's going to take a ruler to my knuckles. So one trade idea I was looking at, it's actually something I'm in play with right now, is GM. I thought that would be an interesting one to throw out there. It got quite a bit short-term oversold over the last several days, closing at a relatively low level on Friday, and we had the Trump tweet this morning that actually took it down a little bit pre-market, but by the time the market opened, it was back up slightly, and it's up slightly right now. But I'm looking for GM to bounce in the next few days. I mean, if Trump can't take it down, who can? Right? Come on. So this is a real short-term trade for me. I'd probably be looking to be out of this by Friday, hopefully, if we get a bounce the next day or two, and maybe even sooner than that. But that is one that I'm looking for a little bit of a bounce in, and I'm looking for a bounce in the broad market as well. So the other way I'm looking to play it over the next few days is just with some index exposure on the long side. That's about it for me. Again, you can find me at quantifiableedges.com. Take a free trial there, or at investaquant.com. Free trials are available at that website as well. And love to. I'm looking forward to coming back. I think next month, David, and hopefully we'll get these guys back, or someone just as interesting, which is pretty doubtful.
Yeah, definitely. All right. Thanks, everyone. Great show. Just a reminder to everyone watching, be sure to hit the YouTube subscribe button if you haven't yet, to make sure to get updates on future shows. Also, you can go to TimingResearch.com and download the most recent report, or any of the past reports, as well as view any of the past shows there. Join us next week. We have Barry Rosen, Neil Batho, John Thomas, Lance Ippolito, and Dave Landry scheduled. And that'll be back to normal time of our normal Monday show, still at 1 p.m. Eastern time. So, and just want to thank my guests again for this week. Anka Metcalf of TradeOutLoud.com, James Ramelli of AlphaShark.com, Jim Kenney of OptionProfessor.com, and Rob Hanna of InvestaQuant.com. So, thanks everyone.
Thank you.